Hello, everyone. This is a special video call with Angelo Gallo. We have even Pete Quigley join us, our American RTA friends. Angelo is also used to be a banker, so he knows a lot about banks. And today, main topic will be to discuss what's happening in the banking system. And after that, I will make some review of where we are sitting on the ranges. Everything that is said here, or nothing that is said here, is an investment advice. If you decide to invest in something, please consult your investment advisor. Also, this video will be uploaded on YouTube. So if you are concerned about, so by staying in this discussion, you are agreeing that this content, including your talk, will be publicly posted. So this is automatically your permission. If you do not wish, please disconnect. Okay, so please, Angelo, what the fuck is going on with the American banks? And
okay, Rob.
Also, we are a lot of people here are from Europe. So what is the risk that this will spread to Europe?
Well, let's get to that in a few minutes. Okay. Do I think it spreads to Europe? Yes, but we'll get there. I haven't thought about Europe too much, but given that quantitative easing took place in Europe, the exact same conditions are setting up in Europe as well. But let's go back to the beginning, okay? Because it's important for everyone to understand where this particular financial crisis came from. So it goes all the way back to the beginning of day one, when quantitative easing began, basically 15 years ago, with Ben Bernanke, and then it continued under Janet Yellen, and then it continued under Jay Powell. And it continues with the Bank of Japan. It continues with the ECB. Okay, well, it stopped about a year ago. Okay, so QE, quantitative easing, had the effect of suppressing interest rates. So that means that interest rates globally caused bonds to be issued, high quality bonds, and specifically here in the United States, treasuries, Fannie Mae's, and Freddie Mac's, which are basically mortgage-backed securities. So during the last, let's call it 14 years under QE, loads and loads of bonds were issued with 1% coupons, 2% coupons, 3% coupons, 4% coupons, okay? Now, at the same time, all of this QE had the effect of creating lots and lots of liquidity. So that liquidity made its way into the various markets, crypto, real estate, collectibles, so on and so forth. But it also caused a lot of cash to be deposited at banks. Now, when banks receive these deposits, they have to do something with the money. And banks were not really crazy about lending because Dodd-Frank here in the United States started to place a lot of restrictions on how much capital a bank had to put up in the way of reserves in order to back up a loan that they would make, whether it be car loans, corporate loans, mortgages, whatever the case may be. At the same time, Dodd-Frank, the Federal Reserve, and the Treasury put in rules that said the banks with all of this excess liquidity could go buy high quality assets, meaning treasuries, Ginnie Mae's, Freddie Mac's, all of that. So the banks, because they didn't have anything to do with this liquidity, they had no borrowers that really wanted to soak it up, plus they had restrictions from Dodd-Frank, they started buying treasuries and mortgage-backed securities, because the government basically incentivized them to do that. It was a way for all of this QE to work its way through the system and essentially get hidden. And it was really a way for the banks to participate in the Fed's QE program because they were the buyers of a lot of this paper. So there's an account that they're allowed to put all of these securities into, and it's called hold to maturity. So all the banks took these securities and put them into this account called hold to maturity. Now, why is that important? Because it meant that they did not have to mark to market these positions, meaning if there's a change in price, they didn't have to mark these positions down and take a hit to their capital or reserve for it. Okay, that's really, really important. And this is why the government is complicit in this whole problem, because they basically said to the banks, look, we need you to participate in this. And so we're going to create a vehicle to allow you to do it. Okay. Now, that whole process played out until the Fed started raising rates last May. And the moment the Fed started raising rates last May, it caused the value of those bonds that were issued at 2%, 3%, 4% to go down in value. Okay, this is real important. So as the Fed continued to raise interest rates, the value of their hold to maturity positions continued to decline.
I would just here note that on the Market Timers YouTube channel, you can replay a video we did last year with Angelo about how treasuries work, their market value, how it goes up when the yield goes down, and vice versa. There's a pretty lengthy explanation there. So if you are still not sure about why the market price goes the opposite way than yields, please replay that video from last year. Sorry to interrupt.
That's okay. Okay, so now 1 year ago, almost 1 year ago, in May of 2022, the Fed starts raising interest rates. The value of all of these safe securities starts declining. Now, mind you, the banks did not take credit risk. Okay, this is not 2008, not even close. Okay, 2008 was tons and tons of credit risk that was embedded in the system. This time around, this one is caused by several things coming to a head at the same time. Number one, the Fed raising interest rates and causing the value of all the bank's positions or bonds, safe securities, in their hold to maturity account declining in value. At the same time that the Fed is raising interest rates, we began a global quad four. Global quad four is when growth begins to decline and inflation begins to decline. So when you think about a global growth slowdown, what you get is more and more people and corporations needing access to their savings that's sitting in the banks. Okay, if their revenues are declining, or if interest rates are going up on your credit card debt or your mortgage or your home equity, or you lost your job, whatever kind of combination it might be that triggers the need for cash. Okay, and that's what began to happen with Silicon Valley Bank. Silicon Valley Bank catered to lots of startups and venture capital companies, and lots of tech, lots of tech startups, lots of healthcare startups. Now, just think about startups for a moment. By definition, startups don't make any money. They burn through cash. Now, we have been in this bear market now, I count 16 months, almost 17 months that this bear market has been going on for. My start for the bear market was November of 2021. That's when the Russell, Bitcoin, and the NASDAQ all peaked out and started to decline. Okay, and then the Dow and the S&P, they peaked out on January 3rd of 2022. Okay, so when you think about the amount of time that has gone by here, these companies have been burning through lots of cash because their revenues are declining, but they still have to make payroll, they still have bills to pay, and they're trying to continue to build out their business models, going smack head into a global economic recession. So what does that do? It means that they are drawing down on their bank savings. Well, as people and corporations and CFOs begin to draw down on their bank savings, that creates a lack of liquidity on the part of the bank. And in the case of Silicon Valley Bank, they had to start selling some of the securities that were in their hold to maturity account. Okay, and in fact, by some estimates, the total value of their hold to maturity was par value 91 billion. And more recently, it's estimated that the value of that portfolio was down to 74 billion. Well, that's roughly a $16 billion decline or hit to capital. Now, Silicon Valley Bank didn't have all of this cash laying around to meet the needs of their depositors' withdrawal requests. Okay, so it was the confluence of events that triggered the run on the bank, so to speak. Now, I will also say that starting early last week, I mean, I could see it because certain banks were starting to get hit by short sellers. What the short sellers did was they did their homework and they decided to start selling short the stocks of those banks that had large hold to maturity accounts. And I'm going to tell you something, JP Morgan is not immune to this. They've got a shit ton of positions in hold to maturity. All right. It's just that people think JP Morgan has a fairly broad base of depositors, unlike Silicon Valley Bank, which was lots of startups which are burning through cash. But if you look at the dollar and you look at treasury bonds, it's very obvious to me that a couple of things are happening. People, CEOs, and CFOs are taking their cash and they're doing two things. They're taking it back home to Europe and Japan or wherever, and they're also buying treasuries because they need to put the money somewhere, but they don't want it all sitting in the bank. Okay, so this process, I don't believe, is going to end anytime soon, because as corporate profits begin to decline even further going into the second quarter and possibly even into the third quarter, if people get laid off, they're going to need money in the bank to live on. That's going to drain bank deposits and thus bank reserves. Corporations, if earnings decline or go negative, right? You know, they still have to pay their bills. They still have to make payroll. So to me, this problem hasn't been solved yet. And I don't believe it's going to go away tomorrow. Because if you look at this new program that the Fed, the Treasury, and the FDIC put into place, it's called the Bank Term Funding Program. It's a loan program where First Republic Bank, for instance, which is an excellent bank, and they're getting hit badly. And they were getting hit badly on Friday, and they were getting hit badly again today. But First Republic can go to this new program, the BTFP, and sell bonds to the Fed at par, so that they will have the cash necessary to meet the withdrawal requests of their depositors. So this problem was not caused by the banks taking undue credit risk or being reckless. This problem lies solely with the central banks and quantitative easing, and having quantitative easing go on for way too long. Then the pandemic hit, and that upset supply chains and all sorts of different things. The various governments pumped even more liquidity into the system, right? Europe did it, the US did it. They sent everybody checks. They did the pandemic loan programs. So what this did was it threw even more cash into the system, and people put that money in the bank, okay, which the banks had to do something. And so they bought more treasuries, which further facilitated QE. So as you can see, it's a self-reinforcing.
Sorry, just I would add here that these banks, because at that time, short-term treasuries had almost no yield. So the long-term treasuries had a little bit higher yield, so they were buying a lot of long-term treasuries. That's the important point, yeah.
That's right. So they were buying treasuries because they fully expected to hold these bonds until maturity. Okay, that's why they put them into this account, because they fully expected that they'd be able to, hold these bonds until maturity, and that would be the end of that. You might say, well, the banks should have understood that at some point interest rates would go up and there'd be a problem. They don't think like that. They had to do something with all of this cash that was coming in the door and being deposited into checking accounts and savings accounts. And the only thing they could do with it is buy treasuries. And plus, like I said earlier, the government wanted them to do that, because when you have the banks buying treasuries, that helps facilitate quantitative easing. If the banks didn't participate, interest rates might have gone higher sooner. In other words, the US Treasury and the EC and European governments might have had to have issued even more bonds in order to continue their spending programs. Okay, so the banks, in my opinion, didn't really do anything wrong, but should they have, last year when the Fed told everyone that they were going to start raising interest rates, should the banks have maybe hedged some of these hold to maturity bonds? Probably. Should they have maybe sold some early on in order to get them off their books early on? Maybe. But again, they they weren't planning for a global slowdown. Okay, they weren't planning for that. But now here we are. Fast forward the clock. Here it is, Monday, March 13th. And everyone needs cash. And just because the Fed and the FDIC and the US Treasury put this program into place doesn't mean that people's fears are going to go away. It's very obvious in the way that they're buying 2-year notes and Treasury bills that they're taking some portion of their bank deposits out of the banks and putting it into treasuries, and that foreigners at the same time are removing some of their cash deposits as well and bringing it back home. So let's talk about the bank program for a moment. It's a 1-year program, which simply means that the banks have 1 year to work this out. Okay. Does this problem end in 1 year? Well, that remains to be seen. And what does the Fed do at the end of 1 year if this problem doesn't go away? Well, the easy answer is they'll just extend the loan program to make it 2 years or something along those lines. You know that they will do something. Okay, they will do something. Now, all the talk today on Bloomberg and CNBC is about what the Fed will do on next week, on March 22nd. Are they going to raise 50 or 25, or will they pause? That's not the issue. The issue here is that the global recession is going to deepen, and more corporations and individuals are going to need savings in order to live on and pay their bills and pay payroll. So it doesn't look to me like this problem is going to go away anytime soon. But 100%, this is all to blame by the central banks. They are the ones that caused this problem. And unless anyone has any questions, that's basically where we're at.
Yeah. So I will start with my first questions. I will start sharing my screen because we have to look at the charts for those questions.
Let me make a couple of another point. One of the reasons why I think we will continue to see bank stocks decline, right, is because this program, and Janet Yellen said it last night, is only to protect the insured depositors and the uninsured depositors. They have no intention, David, of protecting shareholders or bailing out stockholders. Okay, so why is that important? Well, according to Chris Whalen from Whalen Global Advisors, on December 31st of 2022, just 2.5 months ago, according to his calculations, JP Morgan had negative tangible equity of $20 billion. JP Morgan. Okay. Now, everyone thinks, JP Morgan's a big bank. They got plenty of liquidity. Well, the thing here is, if you start to net out the losses in these hold to maturity accounts against bank capital, there's a real problem there. And that's why shareholders are selling their bank stocks, because they realize that if anything else goes wrong, shareholders are going to get wiped out. They're not going to get bailed out the way they did back in 2008.
Yeah, this is really important that this package that was announced on the weekend is basically saying that, okay, so we will guarantee that the depositors can get their money back, but shareholders of those banks and those who borrowed money to the banks, those will not be bailed out, because I mean, already in 2008 you had Occupy Wall Street, so this time it's extremely politically impossible to bail out banks like in the old times. People need to bail them out. I mean, people have a huge debt, huge interest rates, and if it became public that they are bailing out, bank shareholders, that would cause a revolution, right?
Yep.
Revolt, not revolution, revolt.
Yeah. So the bank term funding program that they put in place yesterday, right? The sole purpose of that is to provide a backstop so that all bank depositors, regardless of the amount on deposit, gets their money back. But if you need to meet payroll today, or you have a big bill that's due, the uninsured deposits, it's not like they're going to get their money back right away. It's going to take a little bit of time. Okay, so
they're not going to get them on Monday, because this announcement said that on Monday the deposits will be available. So that was kind of bullshit.
Yes, and at the same time, people are pulling their cash out of banks. They haven't stopped. I got 2 phone calls today already from clients asking me about what's going on, right? And asking me, is the cash in their accounts, in their brokerage accounts safe? And I said, well, number one, your brokerage account has insurance for cash up to $500,000. And the rest is in treasury bills. So,
I mean, with on casual portfolio, the casual portfolio is right now that 50% of capital is in BIL. So we are safe.
yeah, and that's treasury bills as well. Okay.
Short term.
So, yeah. So as depositors continue to be fearful, as depositors continue to need cash, as this global recession continues to play out, because look, just 2-3 weeks ago, it was, oh, it's going to be a soft landing, nothing to worry about, right? And it's typical for the government and regulators to say, well, the problem's contained. It was just Silicon Valley Bank. When you see one cockroach, there's always more cockroaches.
Cockroach in Czech, Schwab. Když je jeden Schwab, tak jich tam je vždycky víc. Sorry.
So, that's where I think we're at. Last night, when the futures opened, markets rallied really, really hard on the assumption that the problem is taken care of. And then when I woke up this morning, the stock indexes, the Dow, the S&P and everything, they were all negative, right? And that's because, two things happened. When Asia closed last night, the futures were, the Dow futures were up 400 points. So if you look at the Asian markets, most of them closed up last night. But then once Europe opened down really hard. Italy opened down 4%, Germany, France, all of them, they opened down like 2.5%. And that spilled over into the US. Now, someone asked the question, David, or you asked the question, could this spill over into Europe? And I would say the answer would be absolutely. Why? Because Europe doesn't have the same fiscal authority. You don't have one central taxing authority. It's a whole bunch of different countries. It's all of the 28 EU countries, right, doing their own thing. And they each have different needs. They each have different banking requirements. They have different banking needs. You have the ECB, but, the ECB would have to be the one that steps up and says, okay, the Italian central bank, okay, Spanish central bank, okay, French central bank, we're gonna have to start buying these securities from you at par so that you can buy them from your local banks, because European banks own tons and tons of corporate debt and government debt, more specifically, tons and tons of government debt. So you have to say to yourself, well, the ECB just started raising interest rates, and the ECB has implemented 15 billion a month of quantitative easing. Well, what is that doing? It's reducing the value of the bonds that Italian banks, French banks, German banks, Dutch banks, Spanish banks are holding on their balance sheets.
And they are holding a lot of them because by regulation, when the rates were negative, by regulation, they were required to buy them because,
You see, David, that's an important point. The monetary and fiscal authorities put programs into place to almost force the banks into buying sovereign debt. See, that's the thing. Now, if the banks had all, US banks, European banks, if they had all gone out and made loans, and they made risky loans to risky companies and zombie type companies, so on and so forth, or subprime mortgages like they did, globally back in 04, 05, 06, 07, 08, you could say, all right, well, they brought it upon themselves. But, again, that's not what they did this time. They bought sovereign debt. They bought US treasuries. Now, let me say something about the mortgage-backed securities that the US banks hold. And this is interesting because a lot of people don't realize that this is actually happening. So if you have a mortgage at 3%, are you going to sell your house and go buy a new house with a mortgage at 7%? No. Okay. So what does that do? It extends the average duration of that mortgage-backed securities portfolio. Nobody with a 2%, 3%, 4% mortgage is refinancing, or are they selling their house and buying a new house? They're staying put. So the effective duration of all of these mortgage-backed securities, Ginnie Mae, Fannie Mae, Freddie Mac, the average duration of this stuff is being extended. And when that type of extension happens, meaning the life of the portfolio, the life of a portfolio of mortgage-backed securities is like 7-8 years. I think now it's pretty much doubled. So now banks thought, well, we were fully expecting to, have these positions for 5, 6, 7 years. Now, all of a sudden, we're stuck with them for 10, 12, 13, 14 years because nobody's going to refinance their house. So what does that do? That causes the value of those mortgage-backed securities to decline even further and create and cause even further stress on bank liquidity and bank reserves, which will further perpetuate this whole liquidity problem. And that's basically where we're at, guys. All right, we're at the crossroads now where we have a liquidity problem.
Okay, so my question is about the crossroads now. So let me share my screen. Yeah, this one. So can you see?
David,
can you see my screen?
Further, David, before you go any further, 14 months ago, I made the statement that the next crisis is going to be induced by the central banks, and here we are. It's always hard to say, right? Did I not, David, 14 months ago say that the crisis would be induced by? Okay, it's always hard to tell exactly how.
Or when.
But it was obvious 14 months ago that something would happen within the banking system.
Yeah. And everybody was no, banks are strong. They have got these stress tests and they have got these rules. But what Fed did, because the rate raising was the speed of hikes was extreme.
Yeah, well,
and that was not part of the stress test, I think.
No. So the rate hikes, the speed of the rate hikes, okay, and also the idea that nobody was expecting any kind of economic slowdown, right? Even Wall Street was projecting S&P earnings to be up another 5% or something on a linear mathematical basis. So they grossly miscalculated the impact of the speed of the rate increases, and they grossly miscalculated the depth and duration of this economic slowdown. And I think I also said, David, that I always believed that this next crisis, this next bear market, would be deeper and longer than 07 to 09. And we are already at the same point as 07 to 09. We're basically at the 17-month mark. And 17 months, David, that's how long the bear market lasted in the great financial crisis. This time, this thing's not even close to being over. And we're at 17 months.
I don't think it has even started, because we had some decline on mainly on the Ukraine war kind of thing, yeah. And then we are consolidating. So the crash has not started.
No. And, you can also see a flight to safety, if that's what you want to call it, in Bitcoin as well. right? Because, certain players are taking, some of their bank cash. Okay, hard to say who these people are, right? And they're buying Bitcoin. But I don't know that I'd call Bitcoin a flight to safety when it's trading at, 24,000, because a flight to safety to me in Bitcoin would be Bitcoin trading at 50 or 60,000, not 24.
Bitcoin is just the dump for liquidity, and there is now going to be more injections of liquidity.
Yes. So, you're gonna see this process take time to play out. And people are going to move money to wherever they think, not that it's necessarily safe, okay, but they're going to move money to wherever they think they can get at it, okay, without any restrictions, right, without any delay. And that's the key psychological aspect to this whole thing. People are worried that if I need my money and I can't get to it, then what? Then what do I do? Oh, well, now I got to sell my blue chip stocks. I certainly got to sell my bank stocks. I got to sell some gold. Okay. I never, ever advocate buying gold in the midst of a crisis. If anyone's long some gold, it hit the top of the range here, and they should probably be selling some on the expectation that there'll be a correction. I did. I sold a little bit more today.
Yeah, once there is a kind of margin call move in indexes, I mean, the crash, when the VIX goes to 35, 40, people are going to be selling gold just to get some liquidity.
Gold is a very liquid asset, and they will understand something, that here's how it works in a bear market. When there's a need for liquidity, the first thing that they start to sell is anything that's high quality. Why? Because it's easy to sell for the least amount of haircut. So blue chip stocks, large cap stocks, right? Gold, probably treasuries, right? Anything that's liquid and high quality is what gets sold first. As you get to the bottom of a bear market, that's when they start to puke all of the other stuff that they couldn't sell, right? Which is all the small cap crap. And that's the stuff that gets sold when it's down 80%, 70%, 90%, right? Because they have no choice. And that's how these things work. That's how they play out. So yes, do I think that if this liquidity issue intensifies, do I think that gold will be on the chopping block? Absolutely.
Okay, so let's. You mentioned that we are here on the crossroads, and we might see maybe we are seeing a kind of a change or progression in the regime. So one thing that I would point out, if you can you see my screen?
Yes.
Yeah. Okay. So last week we had a probability of 50 basis points rate hike at over 40%. It was 50% at some point. Today, if I'm reading this correct, the current rate is 450 to 475,
which is basically unchanged. No rate hike.
So and there's a 92 probability that it will be 97 to 500, so 25 bips hike, right?
Yes. Yes.
So now the probabilities are back to 92% that it will be only 25 basis points. I don't know why they say in media that the probability high that there will be no hike, because I mean, if I'm reading this correctly, the 92% is that there will be 25 basis points hike.
Yes.
I mean,
that's what that's saying.
Yeah. So I look at this, and then I look at this. This is a 2-10-year spread. So this is the yield curve, right? 210.
Yep.
We can see the yield curve has been inverted. It has gone to some really inversion extreme. And what usually inversion says that recession is on a horizon. And as soon as it starts steepening, so the inversion is less and less, and it's called in English steepening. So it goes up. So it used to be, it was a couple trading days ago, it was minus 1%, and now it's minus only 0.66. And when this happens, that means that recession is starting. So my question is, this bank run, does it really mark a regime change from markets trading inflation and rates to trading recession? Does it?
David, I think you froze for a moment. David, unmute yourself. Unmute yourself.
Oh, I'm on a mobile internet. So sorry, I will start sharing the screen again.
Yeah, okay.
Okay, you can see the screen. So
yeah, there we go. Okay.
Okay, so we have now 2 days of or 3 days of steepening. We have a big rally in bonds. Bonds still have not broken out from the downtrend, but we can see already kind of a reversal open range high month in bonds. When at which point, what are you looking for to say, okay, we have transitioned to the next phase of the bear market from trading inflation to trading the recession?
Well, we could be there right now.
It could be, yeah, it could be that moment.
Bonds
are green on daily. Bonds are getting gray on weekly. On monthly, you can say that the low of the range is signaling higher lows, higher highs. It's also gray. So yeah, well,
Well, David, right now, the bond market is telling me two things. It's telling me that some market participants want 30-year paper because of the recession. The 2-year note is telling me that there are lots of CEOs, CFOs that are taking cash out of banks and buying 2-year paper and 1-year paper.
Okay. You can see, and actually on market timers in casual portfolio on Wednesday we were buying SHY because on Wednesday the 2-year yield made a new record, made a new high of over 5%.
Yep. And David, let me say something about that. Going into last Wednesday, there were monster short positions in the 2-year note. So the move that we saw Thursday, Friday, and today, okay, a portion of that is short covering as well.
Yeah. And now the 2-year yield is at a low of range on tail. That means on monthly. We are on the trend low of range. And we can see that we have a consolidation. So we are basically trading the same rates for what, 1, 2, 3, 4, 5, 6 months, right? Yep. Half a year. So so I guess so we'll see what happens next week, what happens with the CPI print, but more probability is that we will be trading this range. So the 2-year yield will go higher. If it breaks down, I think that would be the signal that we are changing the regime, right?
Yes. But, as far as the short end of the curve goes, the Fed's going to have to walk a very fine line here because the CPI is tomorrow, right?
Yeah, we'll see what that is. Yeah.
So, we'll have to see what that is all about. So, on over the weekend, as I was going through all of this, I basically said to a couple of people, I think 2 things are going to happen. I said, number one, I think the Fed is going to have to open up the discount window, which they did.
Actually,
And
can you explain what is the discount window?
yes. So the Fed discount window is where banks go to the Fed and say, I need some liquidity. And they sell to the Fed for a discount bonds, treasuries, mortgage backs, what have you. Anything, any kind of security that the Fed will accept, but it's mostly treasuries and mortgage backs. So the reason it's called a discount window is because when you go to the discount window, the Fed gives you a haircut on that position. So if the bond is worth 100, the Fed might say, okay, we'll take it for 95. Okay.
But still, it's a better deal than selling it at the market price, right?
Well, absolutely. Well, but here's what the Fed did. The Fed yesterday said the discount window is wide open and we will buy your positions at par. So meaning
at par.
At par.
So they can really take their long-term yields, long-term treasuries, and they can sell it to Fed for actually much higher price, like a 25% higher price than it's
that's right,
on the market.
Because most treasuries right now, and David, yes. So most
so this
David,
is what it is. Let's call the discount.
Most treasuries are trading at 70, okay, not 100. Okay, so the bank will go to the discount window and sell the bond at par now. Now, up until yesterday, banks were always very reluctant to go to the discount window, right? There had for years and years, there was always been a stigma attached to any bank that would go to the discount window because it meant that you had a problem and you needed to sell some positions in order to raise cash. So banks always avoided the discount window because they didn't want the marketplace to know what they were doing. Okay, because if the market saw that a bank was going to the discount window, short sellers would start hitting that stock right away because they would see that there was some sort of a problem.
Let me repeat if I'm understanding correctly. Okay, so I am a private investor. I was idiot. I bought bonds, 2 years ago when rates were almost at zero, and right now I bought TLT and I lost 25 to 30% of value, right? So if I wanted to sell them because I want to buy a new car or something, I would lose at least 25%. Now, if I'm a bank and I bought something like TLT, not TLT, but I bought directly the long-term treasuries, let's say 2 years ago, and now I need to sell them because I need to give back money to depositors. So I will get 25% more money for those bonds than an individual who's selling them in the market, and that money is paid by the tax from the taxes of people, right? From the government budget, or
it's the Fed. Now, here's the thing: the Fed's going to end up with losses,
huge ones.
Okay, unless they either stop QT, or they're able to hold some of these bonds to maturity. Okay, so I have a feeling that the Fed will try to hold as much of these bonds to maturity as possible. All right, and how will they do it? They will either stop quantitative tightening, all right, or they may be in a position where they can continue QT, but maybe at a lesser rate. Instead of 95 billion, maybe they change it to 60 billion. Yeah. We'll have to see.
Actually, I have a good note from Tomasz 12. He said, if the value of let's say TLT went down 25%, and Fed will buy your treasuries at the original price, so you will get 33% more, right? Because 25 down is 33 up.
Yeah, yes. But understand, that is only, right, the Fed has waived the discount or the haircut only for now. All right. But I suspect under these emergency powers, they'll probably leave it in place for a while. Now, up until now, why would a bank have to go to the discount window? Well, they would have to go to the discount window because they didn't have enough cash on hand to meet the needs of their depositors, because they had lots of other loans, not necessarily treasury bonds, but other loans, mortgages, real estate loans. And we haven't talked about real estate loans, right? But mortgages, real estate loans. Oh, by the way, regional banks and smaller banks, some of their biggest positions are real estate loans, small commercial real estate, and 1 to 4 family type stuff. A lot of regional banks are big players in their local real estate market. Okay, so keep that in the back of your mind. So anyway, prior to this event, the discount window, if it was ever used by a bank, it was because that bank needed liquidity and they were having some trouble in their loan portfolio. Okay, so okay, we got to go sell some high quality assets to the Fed to generate the liquidity to meet the needs of our depositors.
So basically, my understanding of this is what I've heard with one expert on liquidity, a very interesting interview on the Grant Williams podcast, and basically what Fed is doing, they are doing quantitative easing again. So they are so their recipe for soft landing is to hike rates, but at the same time do a hidden quantitative easing. They are doing quantitative easing in places where nobody understands, because I had no idea what is a fucking
exactly
discount
correct.
window.
Yes, that's exactly correct.
Nobody understands it, so they are doing it soft, and that's why we had this huge monster bear market rally in high beta stocks. Bitcoin is going up because they are again flooding the system with liquidity while they're hiking rates.
That's right. That's exactly what they're doing. Okay, they're putting back into the banks the 30% that the banks just lost on high quality assets. So think about this.
So banks' profits will be higher 33% than they are supposed to be.
The Treasury, the FDIC, the Fed, okay? The Fed is buying the very assets that caused this problem in the first place. Okay, follow that? As opposed to the Fed buying high quality treasuries from a bank because the bank needs it to cover the credit risks they took in the normal course of business. You see the difference? So yes, the 30% haircuts that the bank are being reimbursed for, yeah, that's a de facto form of quantitative easing. Absolutely.
And nobody understands it, and nobody
understands it.
And on Bloomberg, because I haven't watched for a long time. So are they talking about quantitative easing on, because people in Bloomberg or CNBC, they are supposed to be experts. They're supposed to understand it. Are they saying there is quantitative easing?
No,
experts.
They're one factor monkeys. They're still talking about the Fed and inflation. Now, you know, it's important. So to go back to the whole discount window thing. So over the weekend, I thought that 2 things would happen. Number 1, the Fed would have to open the discount window with no haircuts. And number 2, I thought that the Fed would have to, at the very least, pause. Okay. So far, you know, you just went over the rate hike expectations. There's no pricing of a Fed rate cut. There's pricing for the Fed doing nothing next week, or the Fed raising 25 basis points. So think about that for a moment. That is going to continue to keep the pressure onto the consumer, corporations. So the squeeze is not going to go away. Now, if the Fed were to acquiesce here and pause. It looks to me like inflation would probably start to creep back up again.
Yeah.
Which,
all we need is a breakout in oil from that consolidation
to the downside.
to the upside for inflation to, make a new wave.
Oh, yeah. Well,
I think oil will first make a false breakout to the downside. It will do the 50% FIP of that move from 2020 till the cyclical high. So it's gonna, in my opinion, it's gonna make a fake breakdown, and then it's gonna start rallying.
Yep. Well, think about this, David. Oil is down 2% today, while the dollar is down.
Yeah.
Okay. So, there's different asset classes are going to behave differently based upon the market's perception of A, inflation, and or B, the depth of decline in economic growth. Now, I think about this. It's possible that the Fed could pause or even cut rates and inflation continues to go down. Why would that be?
Because of recession.
Well, because of recession, and consumers are scared and they stop spending because they need to hang on to their cash. So, that we could actually get the opposite effect. It's hard to say. We just don't know. See, again, we've never been here before. We've never been in a situation where the Fed did massive QE and then started doing QT. We've never in our history had this before. It's financial alchemy, and we have no idea what kind of chemical reaction we're going to get from this scientific experiment. We're going to find out, though, and I'm pretty certain it's not going to be a good one.
And last thing I wanted to go over is US dollar. Let me just share my screen again so we can look at the chart. So of course, the bonds had a huge rally that impacted dollar. Dollar was short-term overbought. It got to the top of range on daily, on weekly. So now of course, dollar is going down because the rates are going down. But what is the dollar index? The dollar index is mainly euro and yen. So
euro, yen, and some British pounds.
Yeah. So when in Europe shit hits the fan in the banking sector, let me show you the ETF for European banks, and you will all see where's my break even on that chart.
David, if you want to see something interesting with respect to emerging markets, look at dollar Mexican peso.
Actually, I don't want to. I didn't want to show my position because it says how much I have of it. So I'll have to cut this out. Okay. Anyway, so yeah, European banks are down, and so if the shit hits the fan in Europe and the ECB will have to inject liquidity into the European banks, then probably dollar is not going to keep falling down, right?
I don't think so, no.
Yeah. So when I look at Euro USD pair here, so for me on daily we are red, right? Already on weekly we turned red. So for me, I will be shorting near the top of trend range.
I think the yen is a better short right here than the euro.
Really?
Yeah. And the reason for it, David, is because dollar yen is sitting on a matrix level.
Yeah.
And by the way, dollar yen bounced off of the 50-day.
Yeah. These matrix cells don't work so well on currencies. They work best in indexes.
No, they work pretty good. They work pretty good.
Yeah. I don't know. No, well, USD, it's not green yet on the trend. Yeah. But in Europe, once they start, healing banks, or not healing, but injecting liquidity, then euro is going to go down. So, yeah, I'm waiting here for the trend top of range on euro USD pair.
Yep. So there's still lots of tinder out there.
Yeah.
And the first pile of tinder that the Federal Reserve unintentionally lit was all of the high quality assets within the bank's hold to maturity accounts.
Yeah.
That was the first bit of tinder that they lit on fire. Now the question is, are the firemen on the scene, and are the firemen going to stay on the scene, and will the fire spread? And it's going to spread, but probably in a way that we weren't thinking. These conditions are always the same, right? Bear markets, the events that happen are always similar. They're never the same, but the net effect is the same, and that is to take everything down.
Yeah. Okay, so let's see if people have some questions.
Peter, we did that already. So go back to towards the beginning and listen to that.
Yeah, I'm recording it, and later during the day I will upload it to YouTube. Okay, so please, if anybody has a question, let me know in the chat. And we are already 1 hour, so if there is no questions, I think we call it a day.
Yep. Okay, David.
And Angelo, thank you very much. I mean, you are really great at explaining complicated things in an understandable form, and especially for me, this discount window, that was a revelation. Yeah, because I didn't understand what it is.
The thing about this episode is that there are quite a few different nuances that are at play, and they all come together, right, to cause this particular problem. But that's why I stated at the beginning that this problem didn't begin last week. This problem began 15 years ago when the Fed, on the very first day that Ben Bernanke started quantitative easing, and that Janet Yellen continued it, Jay Powell continued it. We got hit with the pandemic, and then everything changed, and inflation started. And that required some sort of a response from the ECB and the US Fed. And other central banks, Australia, Canada, New Zealand, all of them.
Peter, would you like to share with us what are you doing in the markets? What's your stance now? What are you executing?
Well, I think the idea of value at risk suddenly over the last week tells you to get a lot more cautious, and if you're confused on what to do, you can go to T-bills.
Yeah.
And I think it's interesting to try to. I don't think we understand this underlying liquidity draw that's going on. And the thing about it, why I think it's important, is because it's structural. If the economy is slowing and industries start to have it withdrawing capital because they need it for operations, that's structural, and it's not an easy remedy for the Fed. Right now, they're staunching a crisis of confidence, and also shoring up the balance sheet of banks that are guaranteeing the balance sheet. But if we're looking at a scenario where increasingly there's a draw of liquidity out of the system, and I don't think this is visible. I don't think there's a data point that tells you that this is going on. And I think we're kind of going from, kind of seeing examples of it. But I think this is where the whole thing could really accelerate downward. So you have to think about that concept. And Anyway, it was a great discussion, Angelo. Thanks. Got me really thinking. And in terms of Europe, you know, we're not European specialists or banking specialists, but it's the banking situation is there's similarity and difference between Europe, and in Europe it's the sovereigns have really run things, and as interest rates go up, I think that's an obvious problem for the sovereign debt in Europe. I'm not quite sure how the commercial and private loans market gets impacted. But in the US, the consumer debt is a huge phenomenon in US, for instance, and I don't know how big it is in Europe. But
what is specific for Europe? To my knowledge, I'm not expert on banking system, but in Europe, because in America, you have a huge market with corporate debt, for example, you know, the high yield, the junk bonds, and all this stuff. In Europe, the market is very small. And corporates get mainly, you know, these big development projects and infrastructure projects and whatever. It's all fucking financed by banks. Consumer credit is banks.
Yes.
Yeah. So that's a specific of European banks, I think.
Yeah, I think Europe is even more at risk than the US.
yeah, because I do too, and I can't give all the numbers why, but I agree. I agree too. You know, like the French economy, the public sector is more than half of the economy in France. That's an example. So the part of the economy that creates value and wealth is less than half the economy in France. And here you have the public economy, which is massively indebted. Just it's kind of a, you know, to give the structure of the problem in Europe.
So in Europe, we had this really monstrous rally in European banks, because European banks, their stocks, the prices of their stocks were kind of like zombies. They were like, you know, down all the time and never really going up. And suddenly when ECB started raising rates, all the experts here in Europe were saying, oh, buy banks because they are raising interest rates. They're finally not going to be zombies anymore. So there was a huge face-ripping rally in the European banks. And we'll see. I think what Europe is going through is Argentinification. Europe is playing a playbook of Argentina. It's inflation is going up, but they are, you know, spending and printing more. When you look at the charts of, let's say, Brazil and Argentina, this is how the European stocks will trade. There will be a huge rally, and then there will be a huge sell-off, right?
So European stocks had that huge outperformance rally since October, and are they the best short opportunity right now? I mean, from a European perspective.
Okay, let's look at the ranges. So I will share my screen again. Hopefully, I will this time not reveal something I don't want to reveal.
But David, you said something that's important for everyone to understand. The knee-jerk reaction is, oh, rates are going up. That's good for banks. Nope, never is. So, especially when it's in the face of an economic decline.
Yeah. So the Euro stocks and DAX, they look the same. Basically, in the morning, this was actually red, and the weekly was red. So probably tomorrow it will turn red. Yeah. So the momentum has faded, right? We are seeing a change in the signal momentum, and you can see the monthly. You see, it's ORL month. That's a big, that. So to me, this will trade between 3,300 and 4,300. So I think there is a 1,000 points range that it will trade.
So 25%.
Yeah. It's like, it's, if you look at EWZ, this is Brazil. Like, this is what Brazil is doing all the time. Going up 50%, then going, and going down, 33% is the same move. So it's back and forth, and I think that's what Europe is heading for. Of course, this is just my triangulation. I don't have fundamental basis for it, but
there doesn't seem to be a fundamental argument for it to maintain itself at its highs. It doesn't seem to be there.
It's just the Argentinification of Europe. It's basically overprinting inflation. So when you are printing a lot, then you cause a big rally in indexes. Then this causes a problem, and then inflation goes even higher. So then stocks go down, and I think this is the environment that my expectation is just choppy environment and volatile.
Okay.
But definitely, if the daily and weekly turns red, my ambition is to short from top of range, to add to my short, because I'm now reducing the shorts. Some of them are reducing at a loss, but I'm reducing them now. I wasn't reducing them 2 weeks ago or a week ago. So yeah, so in the EUFN, my short of European banks today, I covered on casual portfolio. I covered some at a loss, but the loss today was not so big like a week ago. But still, I also want to see weakness in euro currency. We'll see. We just need to see the spillover of the problems into Europe with the banking. That's what because all these European indexes, especially the Italian one, the Italy 40, that's full of banks. So look at the Italy today. It's like a huge, because this is banks, right? And whenever you get such a bar, monthly bar like this, that's never bullish. But basically, if it's not reverted next month to the upside, that means that you will, these prices here, you will not see them for multiple months, right, Angelo? Like this is what this is a very strong thing. This ORL monthly bar. This is a. Let's look at. Maybe I will switch it to quarterly.
That's a monthly ORL. That's not good.
Yeah. We don't see ORL on quarterly, but look at this Italy on quarterly. It's just a fucking Argentina and not Argentina, but Brazil. It goes nowhere.
And the fact that it goes nowhere means you can't buy and hold because you won't make any money. If you happen to buy at the low end of the range, all right, and it goes to the top of the range, if you don't sell it there, it's going to go back to the bottom of the range again.
Exactly.
And you end up accomplishing nothing, and that's where we're at right now. Although, look, we are, breaking down below this consolidation zone. So, the fact that we violated 3871, that's a problem.
I wanted to also make a short review of SPX. I don't want to look at the futures because we are in the rollover process. So the data will not be very clear because there is a big spread between the March and June contract. Just to educate people, the difference between the price of the S&P futures, the difference between those contracts prices is bigger. The bigger, the higher are interest rates, the higher the future value of money is. So now it's like really big spread.
The Junes are trading at about a 35-point premium.
Exactly. So let's look at
that's a lot. That's a lot, by the way.
That's a lot because interest rates are high. So if we look at the SPX, well, let's look at the monthly. So basically, we are in this consolidation: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So we are almost 1 year consolidating. Now we hit a monthly low of range. Today, actually, we did that. We hit low of range on weekly. So basically, yeah, I mean, today was time to, when we were nearing to the 3,800, that was the time to, and there was a huge put wall there as well. So that was the time to take profits. And what the market needs to do, they need to kind of break down these low of ranges. They need to break them down. And first, first they have to, get under 3,800, and then we can talk about some, possibility of some crash. Then there is this monthly 50 moving average that's around 3,700. So that would be the next target. But right now we are in this consolidation, part of the consolidation that started in December. We got close to the December lows, and we'll see, because the longer we are in this, the worse the economy is getting. I mean, of course, we had some positive economical prints. We had some upticks in January, right? What were the upticks? There was ISM uptick, right? PMI, there was an uptick, if I'm correct.
You had retail sales.
Retail sales had an uptick.
Yes, but unfortunately, right, those are just month-to-month numbers that the market kind of focuses on, and you combine that with some of the liquidity that was still in the markets or in the system, and there was enough of a catalyst there to get a little bit of a bear market rally in January. But that
actually
ended on February 2nd.
I wanted to look at China. Let's look at China through KBA. Do you still think KBA is the best vehicle for broadly, like doing China?
Probably, yeah.
So China had a huge, not uptick, but they had a huge expansion after the reopening. They had a huge expansion of production, right? Of course, those numbers are manipulated, but the rate of change cannot be manipulated. So there was a big kind of a macro positive for China. I think Germany was riding that. So on the weekly time frame, we are barely green. We are getting gray. Let's look at FXI if it's the same picture. Yeah, FXI is the same picture. So we are getting gray on weekly. And on monthly, we are still green. So my question is, and maybe that's what I will do, is I will buy some China when we get to the kind of tail loaf range. The problem is that China is just, markets are capitalism, and that's a communist dictatorship, and I don't know.
Yeah, David, for me personally, and for client accounts, I have
China.
China. I have a variety of reasons why I'm just going to stay away.
Yeah. The other thing is maybe instead of China, maybe South Korea, but that's already right. India is done. Let's look at Nifty. You see, India is red. It's just that rally in India is done. I mean, it's a consolidation, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So the consolidation is already a year and a half, but this looks like a topping, doesn't it? The Nifty 50. So, India is going to go to hell.
India is bearish. It's bearish trade and trend, and that's all you need to know.
Exactly. So basically, yeah, there I'm waiting. There I'm also planning to short at the top of range, not on the top of daily range, because keep in mind that the tail range, we have a high consolidation index. It's still like 55. That means, and we are still kind of in the middle of the big consolidation. So I never used the swing ranges, the daily ranges to execute. I always use the ranges from higher time frame if the higher time frame is in consolidation, right? So be careful about that. That's very important. Where you want to use the swing range, I'll give you a couple of examples where I will use.
Hey, David, before you go any further, let me ask you a question. What are those little I'll call them lightning bolts inside a circle on each of the charts?
This?
Yeah, what is that?
This is a trading view news, kind of
Oh, okay.
summary of news.
Okay.
So, for example, oil, energy, oil. Okay, so we have this consolidation in oil. As I'm telling everyone, the 50% FIP in oil is 68, right? Something. So if oil breaks out from this consolidation to the upside, I will try to get on long from daily ranges. Another example is bonds. So rates, if we are doing, if bonds, and bonds are just starting to consolidate here, right? You can see we have got 1, 2, 3, 4 months in consolidation. But when bonds break out and all these timeframes are starting to be green, then I will then I will start to try to catch on the breakout with swing range. The thing about bonds, it's always in the history. I looked at all the history. Inflation always has at least 2 waves, and we have seen only 1 wave. If inflation goes above 5-6%, it has a second wave. We haven't seen that. Also, we haven't seen rates, Fed fund rates above inflation rate. So that's 2 things that's why I don't want to go long bonds, because at some point we can see a wild bear market rally in bonds, but we are still in a bloody bear market.
I think the reacceleration in inflation is not in front of us at this time, but
it could be second half of the year when
something like that.
Second half of the year, it could be, right? So
yeah.
But if you see a breakout, for example, if you see a breakout in a gold going up, precious metals, gold. So if we start, so in gold, that consolidation. Okay, let me put it. So this is a monthly chart. We are trading the same prices from July of 2020. So we are almost 2 years in a consolidation. It needs to break out first, right? And I think if we get a crash in these indices, we will visit the low of range on monthly, which is like 1733. I was at some point calculating the 50% FIB. So if you take, let me change it to 3 months, and here to 3 months. So let's make this long-term FIB from the 2015 low. By the way, that's FIBs work well on the biggest time frames. If you make FIB intraday, you will not make any edge. Now, so the it's 1570 is the end. We almost got there in July, but not fully. So my expectation is that in case we have a crash in the indexes, then gold will make a false breakout to the downside to the FIB, and then it will start the big rally. But who knows? But yeah, now we are at the top of range. You are at the top of range of almost 2 years long consolidation. You don't want to buy gold at the top of range. You don't. So just saying. I might be wrong, and if I'm wrong, and the gold breaks out and gold goes above 2,000 and 2,100. I will catch along on a pullback from the swing ranges, right?
Yep. Our process says never ever chase.
Yeah. Okay, so Angelo, again, thank you for your time. Pete, thank you for your time. It was a great input. We are here a whole bunch of people, and most of our subscribers here are from Czech Republic. Czech Republic is a country that had no capitalism until until 1990s or until 2000, and capitalism and capital markets are very new to us. People are really learning that from scratch, what is investing, and being able to talk to experienced money managers from United States, that's very precious for us. Thank you very much.
See you later.
Have a good day.
All right. Thanks a lot, David. Good job.